Nigeria, like many other developing nations, has taken loans from the International Monetary Fund to support its economy.
Debt servicing. A significant problem is the high interest rates and strict repayment schedules. This results in a large part of the country's revenue being used for debt servicing, thus limiting the funds available for development projects.
Economic policy. Influence. IMF loans often come with conditions requiring structural adjustments or economic reforms. While these policies may be intended to improve economic stability, they can also limit the government's ability to implement policies that are tailored to the country's specific needs and circumstances.
Increased inflation. The IMF often requires borrowing countries to devalue their currency. While this can make exports cheaper and potentially boost economic growth, it can also lead to increased inflation, making everyday goods more expensive for the population.
Austerity measures. To meet the IMF's requirement for fiscal discipline, governments often have to cut spending, leading to austerity measures. These can include reductions in public services and social safety nets, which can disproportionately affect the poor and vulnerable.
Social unrest. The implementation of economic reforms and austerity measures can lead to social unrest. For instance, removal of subsidies on fuel and utilities, a common requirement from the IMF, can spark protests and strikes.
Dependency. Continued borrowing can lead to a dependency on IMF loans, limiting the country's financial autonomy and potentially creating a cycle of debt.
Inequality. Some critics argue that IMF policies often lead to increased income inequality, as the benefits of economic reforms are not evenly distributed.
Lack of transparency. IMF loans and the conditions attached to them are often negotiated behind closed doors, leading to a lack of transparency and accountability. This can fuel corruption and mismanagement of funds.
It's important to note that while the IMF provides financial assistance with the intention of stabilizing economies and promoting growth, the effectiveness and impact of its loans can vary greatly depending on a range of factors, including how well the required reforms are implemented and the overall economic context of the borrowing country.